29 Warren Buffett quotes on investing and success. Warren Buffett is obviously incredibly successful. He's built his wealth long-term to over $75 billion approx, making him one of the richest men in America. Warren lives by his certain set of values that he uses to invest and make other life decisions. He has some great advice that we can use to be successful. Take a look at 29 intelligent and inspiring quotes on investing and success from Warren Buffett, one of the world's most wealthy people. Number 1. Buffett's only 2 rules for investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Number 2. The market can price things wrong. Price is what you pay. Value is what you get. Number 3. High returns with low risk is the key. Risk comes from not knowing what you are doing. Number 4. Get around the right people. It's better to hang out with people better than you. Pick out associates whose behavior is better than yours and you'll drift in that direction. Number 5. It's easier to look back than to look into the future. In the business world, the rearview mirror is always clearer than the windshield. Number 6. Buy wonderful companies. It's far better to buy a wonderful company at a fair price, than a fair company at a wonderful price. Number 7. Your public image and reputation. It takes 20 years to build a reputation and 5 minutes to ruin it. If you think about that, you'll do things differently. Number 8. It's okay to dream big. I always knew I was going to be rich. I don't think I ever doubted it for a minute. Number 9. Invest for the long term. Only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. Number 10. Buy it thinking you will hold it forever. Our favorite holding period is forever. Number 11. People make investing seem more difficult than it should. The business schools reward difficult, complex behavior more than simple behavior, but simple behavior is more effective. Number 12. Doing nothing is often the right thing to do. You do things when the opportunities come along. I've had periods in my life when I've had a bundle of ideas come along, and I've had long dry spells. If I get an idea next week, I'll do something. If not, I won't do a damn thing. Number 13. On finding honesty in others. Honesty is a very expensive gift. Don't expect it from cheap people. Number 14. Appreciate where you came from. Someone's sitting in the shade today because someone planted a tree a long time ago. Number 15. Give back to society. If you're in the luckiest 1% of humanity, you owe it to the rest of humanity to think about the other 99%. Number 16. Don't make investing difficult. There seems to be some perverse human characteristic that likes to make easy things difficult. Number 17. Make your own forecasts. Forecasts may tell you a great deal about the forecaster, they tell you nothing about the future. Number 18. It's usually best to just say no. The difference between successful people and really successful people is that really successful people say no to almost everything. Number 19. Do what you love. In the world of business, the people who are most successful are those who are doing what they love. Number 20. Actions versus results. You keep doing the same things and you keep getting the same result over and over again. Number 21. Invest only in companies you know and trust. An investor should act as though he had a lifetime decision card with just 20 punches on it. Number 22. Manage your time better. You've gotta keep control of your time, and you can't unless you say no. You can't let people set your agenda in life. Number 23. Great investors don't diversify. Diversification is protection against ignorance. It makes little sense if you know what you are doing. Number 24. Seize great opportunities and load up the truck. Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Number 25. History doesn't dictate the future. If past history was all that is needed to play the game of money, the richest people would be librarians. Number 26. Choose your heroes wisely. Tell me who your heroes are and I'll tell you who you'll turn out to be. Number 27. Make long-term investments over short-term ones. If you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. Number 28. Don't be greedy. Not doing what we love in the name of greed is very poor management of our lives. Number 29. Spend time on personal development. The most important investment you can make is in yourself. Did I miss any of your favorite quotes? Leave a comment in the comments section. Remember this, Warren Buffett started with $100 and turned it into $30 billion. That means that it isn't about the money you have, it's about the knowledge you have. It means there are no real barriers to you getting rich if you're willing to work hard and learn. 101 Handpicked Warren Buffett quotes on investing. Warren Buffett, better known as the Oracle of Omaha, Sage of Omaha or Wizard of Omaha, is obviously the most successful investor of all times. He is not only known for his investment philosophy but also for his great quotes on investing. So, I'm going to share with you 101 quotes by Warren Buffett on investing that I find inspiring. So I'm going to include some famous quotes from his annual letters as well. 101 Famous Quotes by Warren Buffett on Investing. Number 1. Never invest in a business you cannot understand. Number 2. Always invest for the long term. Number 3. No matter how great the talent or efforts, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. Number 4. Whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. Number 5. What we learn from history is that people don't learn from history. Number 6. Buy a business, don't rent stocks. Number 7. You don't need to be a rocket scientist. Investing is not a game where the guy with the 160 IQ beats the guy with 130 IQ. Number 8. We have long felt that the only value of stock forecasters is to make fortune tellers look good. Number 9. A prediction about the direction of the stock market tells you nothing about where stocks are headed, but a whole lot about the person doing the predicting. Number 10. Someone sitting in the shade today because someone planted a tree a long time ago. Number 11. I really like my life. I've arranged my life so that I can do what I want. Number 12. We will only do with your money what we would do with our own. Number 13. If you don't feel comfortable owning something for 10 years, then don't own it for 10 minutes. Number 14. I am a better investor because I am a businessman and a better businessman because I am an investor. Number 15. Price is what you pay. Value is what you get. Number 16. The stock market is designed to transfer money from the active to the patient. Number 17. Stop trying to predict the direction of the stock market, the economy, interest rates, or elections. Number 18. I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 10 years. Number 19. By periodically investing in an index fund, the know-nothing investors can actually outperform most investment professionals. Number 20. I have pledged to always run Berkshire with more than ample cash. I will not trade even a night's sleep for the chance of extra profits. Number 21. The best business returns are usually achieved by companies that are doing something quite similar today to what they were doing 5 or 10 years ago. Number 22. Investing is laying out money now to get more money back in the future. Number 23. The stock market is a no-called strike game. You don't have to swing at everything, you can wait for your pitch. Number 24. Never count on making a good sale. Have the purchase price be so attractive that even a mediocre sale gives good results. Number 25. I don't look to jump over 7-foot bars, I look around for 1-foot bars that I can step over. Number 26. For some reason, people take their cues from price action rather than from values. What doesn't work is when you start doing things that you don't understand or because they worked last week for somebody else. The dumbest reason in the world to buy a stock is because it's going up. Number 27. Never give up searching for the job that you're passionate about. Try to find the job you'd have if you were independently rich. Forget about the pay. When you're associating with the people that you love, doing what you love, it doesn't get any better than that. Number 28. We don't get paid for activity, just for being right. As to how long we will wait, we'll wait indefinitely. Number 29. As Buffett said in the speech, he's not looking at quarterly earnings projections, he's not looking at next year's earnings, he's not thinking about what day of the week it is, he doesn't care what investment research from any place says, he's not interested in price momentum, volume or anything. He's simply asking, what is the business worth? Number 30. Buy companies with strong histories of profitability and with a dominant business franchise. Number 31. Most people get interested in stocks when everyone else is. The time to get interested is when no one else is. You can't buy what is popular and do well. Number 32. Our approach is very much profiting from lack of change rather than from change. With Wrigley chewing gum, it's the lack of change that appeals to me. I don't think it is going to be hurt by the internet. That's the kind of business I like. Number 33. When asked how he became so successful in investing, Buffett answered, "We read hundreds and hundreds of annual reports every year." Number 34. When a management team with a reputation for brilliance joins a business with poor fundamental economics, it is the reputation of the business that remains intact. Number 35. I try to buy stock in businesses that are so wonderful that an idiot can run them. Because sooner or later, one will. Number 36. Only those who will be sellers of equities in the near future should be happy at seeing stocks rise. Prospective purchasers should much prefer sinking prices. Number 37. Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. Number 38. Wide diversification is only required when investors do not understand what they are doing. Number 39. You're neither right nor wrong because other people agree with you. You're right because your facts are right and your reasoning is right. That's the only thing that makes you right. And if your facts and reasoning are right, you don't have to worry about anybody else. Number 40. It takes 20 years to build a reputation and 5 minutes to ruin it. If you think about that, you'll do things differently. Number 41. The first rule is not to lose. The second rule is not to forget the first rule. Number 42. Only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. Number 43. I will tell you how to become rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful. Number 44. Why not invest your assets in the companies you really like? As Mae West said, too much of a good thing can be wonderful. Number 45. Our favorite holding period is forever. Number 46. Investing is laying out money now to get more money back in the future. Number 47. The most important thing to do if you find yourself in a hole is to stop digging. Number 48. Money is not everything. Make sure you earn a lot before speaking such nonsense. Number 49. When a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. Number 50. Risk comes from not knowing what you're doing. Number 51. Unless you can watch your stock holding decline by 50% without becoming panic-stricken, you should not be in the stock market. Number 52. The critical investment factor is determining the intrinsic value of a business and paying a fair or bargain price. Number 53. Investors making purchases in an overheated market need to recognize that it may often take an extended period for the value of even an outstanding company to catch up with the price they paid. Number 54. It's better to hang out with people better than you. Pick out associates whose behavior is better than yours and you'll drift in that direction. Number 55. Risk can be greatly reduced by concentrating on only a few holdings. Number 56. It is not necessary to do extraordinary things to get extraordinary results. Number 57. An investor should ordinarily hold a small piece of an outstanding business with the same tenacity that an owner would exhibit if he owned all of that business. Number 58. Diversification may preserve wealth, but concentration builds wealth. Number 59. Great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. Number 60. You won't keep control of your time, unless you can say no. You can't let other people set your agenda in life. Number 61. In the business world, the rearview mirror is always clearer than the windshield. Number 62. If a business does well, the stock eventually follows. Number 63. Cash never makes us happy, but it's better to have the money burning a hole in Berkshire's pocket than resting comfortably in someone else's. Number 64. Wall Street is the only place that people ride to in a Rolls-Royce to get advice from those who take the subway. Number 65. A public opinion poll is no substitute for thought. Number 66. I never buy anything unless I can fill out on a piece of paper my reasons. I may be wrong, but I would know the answer to that. I'm paying $32 billion today for the Coca-Cola Company because. If you can't answer that question, you shouldn't buy it. If you can answer that question, and you do it a few times, you'll make a lot of money. Number 67. The investor of today does not profit from yesterday's growth. Number 68. I knew a lot about what I did when I was 20. I had read a lot, and I aspired to learn everything I could about the subject. Number 69. You only have to do a very few things right in your life so long as you don't do too many things wrong. Number 70. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Number 71. You ought to be able to explain why you're taking the job you're taking, why you're making the investment you're making, or whatever it may be. And if it can't stand applying pencil to paper, you'd better think it through some more. And if you can't write an intelligent answer to those questions, don't do it. Number 72. Look at market fluctuations as your friend rather than your enemy, profit from folly rather than participate in it. Number 73. An investor needs to do very few things right as long as he or she avoids big mistakes. Number 74. Do a lot of reading on how to determine the value of a business. Number 75. Somebody once said that in looking for people to hire, you look for 3 qualities: integrity, intelligence, and energy. And if you don't have the first, the other 2 will kill you. You think about it, it's true. If you hire somebody without integrity, you really want them to be dumb and lazy. Number 76. Only when the tide goes out do you discover who's been swimming naked. Number 77. The fact that people will be full of greed, fear, or folly is predictable. The sequence is not predictable. Number 78. Time is the friend of the wonderful company, the enemy of the mediocre. Number 79. I do not like debt and do not like to invest in companies that have too much debt, particularly long-term debt. With long-term debt, increases in interest rates can drastically affect company profits and make future cash flows less predictable. Number 80. We will reject interesting opportunities rather than over-leverage our balance sheet. Number 81. I always knew I was going to be rich. I don't think I ever doubted it for a minute. Number 82. Turnarounds seldom turn. Number 83. If at first you do succeed, quit trying on investing. Number 84. I don't measure my life by the money I've made. Other people might, but certainly don't. Number 85. Anything can happen in stock markets and you ought to conduct your affairs so that if the most extraordinary events happen, that you're still around to play the next day. Number 86. You shouldn't own common stocks if a 50% decrease in their value in a short period of time would cause you acute distress. Number 87. With few exceptions, when a manager with a reputation for brilliance tackles a business with a reputation for poor economics, it is the reputation of the business which remains intact. Number 88. The business schools reward complex behavior more than simple behavior, but simple behavior is more effective. Number 89. It's not debt per se that overwhelms an individual, corporation, or country. Rather, it is a continuous increase in debt in relation to income that causes trouble. Number 90. A great investment opportunity occurs when a marvelous business encounters a one-time huge, but solvable problem. Number 91. You do not adequately protect yourself by being half awake when others are sleeping. Number 92. We like to buy businesses, but we don't like to sell them. Number 93. Money to some extent sometimes let you be in more interesting environments. But it can't change how many people love you or how healthy you are. Number 94. It's us fun being a horse when the tractor comes along, or the blacksmith when the car comes along. Number 95. Enjoy your work and work for whom you admire. Number 96. With enough insider information and $1 million, you can go broke in a year. Number 97. Read Ben Graham and Phil Fisher. Read annual reports, but don't do equations with Greek letters in them. Number 98. In a commodity business, it's very hard to be smarter than your dumbest competitor. Number 99. A hyperactive stock market is the pickpocket of enterprise. Number 100. Valuing a business is part art and part science. Number 101. Chains of habits are too light to be felt until they are too heavy to be broken. One of Buffett's investment philosophy succinctly. This quote is below. We select such investments on a long-term basis, weighing the same factors as would be involved in the purchase of 100% of an operating business. 1. Favorable long-term economic characteristics. 2. Competent and honest management. 3. Purchase price attractive when measured against the yardstick of value to a private owner, and 4. An industry with which we are familiar and whose long-term business characteristics we feel competent to judge. That's it. That's the basic secret formula to Warren Buffett's $75 billion fortune. The Buffett quote categories are listed below. Long-term investing. Do nothing investing. Circle of competence. Great businesses and competitive advantages. When to buy. When to sell. Risk and leverage. Personal finance and life tips. Charity and legacy. History and forecasting. Bull markets and crowd thinking. Investing tips. Management. Final thoughts. 11 long-term investing quotes from Warren Buffett. Warren Buffett is a long-term investor. 3 of his longest holdings are shown below. American Express, AXP, first purchase in 1964. Coca-Cola, KO, first purchase in 1988. Wells Fargo, WFC, first purchase in 1989. I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 5 years. This quote shows Warren Buffett thinks in investing time frames of at least 5 years. But his holding period is preferably much longer. Only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. And if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Do nothing investing. Warren Buffett's partner Charlie Munger has coined a new word for their ability to not act on every investment that comes by: assiduity. Assiduity is the ability to sit on your ass and do nothing until a great opportunity presents itself. Charlie Munger. Warren Buffett and the Circle of Competence. You don't have to be an expert on every stock to find great businesses trading at fair or better prices. The less complicated an investment is, the less room for error in your analysis. Similarly, sticking to investing in businesses you understand well is critical to minimizing investing mistakes. Warren Buffett calls sticking with what you know staying in your circle of competence. What an investor needs is the ability to correctly evaluate selected businesses. Note that word selected. You don't have to be an expert on every company, or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important, knowing its boundaries, however, is vital. 8 quotes from Warren Buffett on when to buy. Warren Buffett's buying wisdom can be condensed into 2 statements. 1. Buy great businesses when they are trading at fair or better prices. 2. This occurs when short-term traders become pessimistic. The 8 quotes below clarify Warren Buffett's thinking on when to buy great businesses. Long ago, Ben Graham taught me that price is what you pay, value is what you get. Whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. In the quote above, Buffett explains that he acquired his value-focused mindset from his mentor Benjamin Graham. Graham was the father of value investing and a fantastic investor in his own right. It makes sense that his philosophies significantly influence Warren Buffett. There is a stark difference in investing style between Graham and Buffett. Graham focused on deep value plays, businesses that were trading below liquidation value. These were typically poor businesses that were undervalued because they had such bad future prospects. Buffett focuses on great businesses trading at fair or better prices, as the quote below clarifies. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Wonderful companies compound your wealth year after year. Poor quality businesses that are exceptionally cheap only grow your wealth once, when you sell them, hopefully for a profit. Note that Buffett does not say to buy great businesses at any price. For the investor, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. Overpaying severely limits the growth of your wealth. If you pay for a large part of future growth today, you will not benefit from that growth down the line. Great businesses can be very overvalued. Most people get interested in stocks when everyone else is. The time to get interested is when no one else is. You can't buy what is popular and do well. You don't need to be a contrarian to do well in investing, but you do need to exhibit emotional control and be realistic. Just as great businesses can be overvalued, they can also be undervalued. The best thing that happens to us is when a great company gets into temporary trouble. We want to buy them when they're on the operating table. It's not easy to buy great businesses when they are on the operating table. That's because the zeitgeist is decidedly against buying. Stocks become undervalued because the general consensus is negative. Intelligent investors profit from irrational fears. Be fearful when others are greedy and greedy only when others are fearful. Fear and market corrections create opportunities for more patient, long-term investors. The 2 quotes below expand upon this. So smile when you read a headline that says investors lose as market falls. Edit it in your mind to disinvestors lose as market falls, but investors gain. Though writers often forget this truism, there is a buyer for every seller and what hurts one necessarily helps the other. And the most common cause of low prices is pessimism, sometimes pervasive, sometimes specific to a company or industry. We want to do business in such an environment, not because we like pessimism but because we like the prices it produces. It's optimism that is the enemy of the rational buyer. Paying too high a price is an investing risk that can be avoided, for the most part, by staying disciplined. Buying is only half of investing. The next section covers when to sell. Buffett on risk and leverage. Modern portfolio theory argues that stock price volatility is a proxy for risk. Wide diversification is preferred over concentrated investing. Buffett has invested in a far more concentrated manner. Here's where Buffett says risk comes from. Risk comes from not knowing what you're doing. Buffett places an emphasis on knowing what he is doing by staying in his circle of competence. Rule number 1, never lose money. Rule number 2, don't forget rule number 1. In fact, he prefers minimal risk to higher risk and potentially higher profits. When forced to choose, I will not trade even a night's sleep for the chance of extra profits. Rather than invest broadly in businesses he is less confident in, Buffett runs a focused portfolio invested in his highest conviction ideas, as the two quotes below show. Keep all your eggs in one basket, but watch that basket closely. And diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. Buffett does not use diversification to mitigate risk. Instead, he reduces risk by examining businesses closely and understanding their competitive advantage. We believe that a policy of portfolio concentration may well decrease risk if it raises, as it should, both the intensity with which an investor thinks about a business and the comfort level he must feel with its economic characteristics before buying into it. In stating this opinion, we define risk, using dictionary terms, as the possibility of loss or injury. A rising tide lifts all boats. In bull markets, investors who take on more risk by using leverage will look like geniuses. When sentiment changes and a recession occurs, these leveraged portfolios will not look so smart. It's only when the tide goes out that you learn who has been swimming naked. Warren Buffett does use some leverage in his investing, but he only uses non-callable, ultra-low-interest leverage. He also does not leverage himself excessively. More of Buffett's thoughts on leverage are in the two quotes below. When you combine ignorance and leverage, you get some pretty interesting results. And I've seen more people fail because of liquor and leverage being borrowed money. You really don't need leverage in this world much. If you're smart, you're going to make a lot of money without borrowing. Avoiding excess leverage and being cautious with your investments takes willpower and maturity. The next section covers Warren Buffett's tips for life and personal finance. History and forecasting. The financial industry produces a great deal of forecasts. Economists and financial analysts make a plethora of guesses about company growth rates, country growth rates, margins, and much more. Warren Buffett does not believe these forecasts are particularly valuable. We've long felt that the only value of stock forecasters is to make fortune tellers look good. Even now, Charlie and I continue to believe that short-term market forecasts are poison and should be kept locked up in a safe place, away from children and also from grown-ups who behave in the market like children. Instead of guessing at future growth rates, Buffett looks for great businesses that are trading at fair or better prices now. In the 54 years Charlie Munger and I have worked together, we have never foregone an attractive purchase because of the macro or political environment, or the views of other people. In fact, these subjects never come up when we make decisions. Forecasts do have some value, however. They tell you what the forecaster is thinking. Forecasts may tell you a great deal about the forecaster, they tell you nothing about the future. Investing success comes from a mix of understanding history and understanding the current competitive position of businesses. Wise investors learn from their own past mistakes, and those of others. The best thing is to learn from other guys' mistakes. General George S. Patton used to say, "It's an honor to die for your country. Make sure the other guy gets the honor." There are a lot of mistakes that I've repeated. The biggest one, the biggest category over time, is being reluctant to pay up a little for a business that I knew was really outstanding. The history of a business will tell you more about that business than guesses about the future, forecasts. In the business world, the rearview mirror is always clearer than the windshield. Unfortunately, few investors, and people in general, learn from their own mistakes or mistakes made throughout history. What we learn from history is that people don't learn from history. A detailed analysis of a business history is not all you need for successful investing. You must also understand valuation and the current competitive advantage of a business. You can put too great an emphasis on history. If past history was all that is needed to play the game of money, the richest people would be librarians. This is especially true of highly specific, not broad-based, quantitative models that rely on a great many assumptions to work. Investing should not be overly complicated. The more assumptions you make, the more likely you are to be wrong. Investors should be skeptical of history-based models. Constructed by a nerdy-sounding priesthood using esoteric terms such as beta, gamma, sigma and the like, these models tend to look impressive. Too often, though, investors forget to examine the assumptions behind the models. Beware of geek-sparing formulas. The realization that few people learn from history is best exemplified by investor irrational exuberance during the height of bull markets and investing manias. Warren Buffett quotes on bull markets and crowd thinking. When you think about stock market investors, what comes to mind? Do you picture an army of Ivy League educated MBAs making detailed and rational decisions about what to invest in? There are a lot of extremely intelligent people in the investing industry. But markets as a whole are prone to irrationality. People are greedy and fearful. When easy money is around, bull markets, greed pushes people to take greater risks than they otherwise would. You need to divorce your mind from the crowd. The herd mentality causes all these IQs to become paralyzed. I don't think investors are now acting more intelligently, despite the intelligence. Smart doesn't always equal rational. To be a successful investor, you must divorce yourself from the fears and greed of the people around you, although it is almost impossible. And nothing sedates rationality like large doses of effortless money. Bull markets make mediocre investors think and believe they are investing geniuses because of the gains they see in their investment account. In a bull market, one must avoid the error of the preening duck that quacks boastfully after a torrential rainstorm, thinking that its paddling skills have caused it to rise in the world. A right-thinking duck would instead compare its position after the downpour to that of the other ducks on the pond. You have to do things differently to avoid taking too much risk during market manias. Misery loves company. No one gets blamed for failing when everyone else is. Failing conventionally is the route to go. As a group, lemmings may have a rotten image, but no individual lemming has ever received bad press. Bubbles typically start with a good reason. Those who get in early do well. It's the individual investor who is the last to catch on that ends up holding the bag. What the wise do in the beginning, fools do in the end. All bubbles burst, eventually. When they do, investors relearn the same lessons over again. But a pin lies in wait for every bubble. And when the two eventually meet, a new wave of investors learns some very old lessons. First, many in Wall Street, a community in which quality control is not prized, will sell investors anything they will buy. Second, speculation is most dangerous when it looks easiest. Being able to maintain an even keel and not overreact to optimism or pessimism is critical for investing success. The most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Sober judgment is a commodity in a world of emotional investors. You're dealing with a lot of silly people in the marketplace. It's like a great big casino and everyone else is boozing. If you can stick with Pepsi, you should be okay. Does this mean you should always do what is opposite of the consensus? No, you should act irrespective of the consensus. Sometimes the crowd will agree with you, sometimes it doesn't. You should be equally comfortable with either situation. In some corner of the world they are probably still holding regular meetings of the Flat Earth Society. We derive no comfort because important people, vocal people, or great numbers of people agree with us. Nor do we derive comfort if they don't. Controlling behavior is a much larger part of investing success than many investors first realize. The 7 tips below from Warren Buffett give us deeper insight into how to think about investing. Final thoughts. Warren Buffett is arguably the greatest investor of all time. Warren Buffett. To give you deeper insight into the thought processes of Buffett. Warren Buffett's quotes show that he looks for 1. Businesses with strong competitive advantages. 2. trading at fair or better prices. 3. With shareholder-friendly managements. 4. That can be held for the long run.